Hello everyone and welcome to this week's live FX market analysis. My name's Craig Erlam, Senior Market Analyst at OANDA. Thank you very much all for joining us once again. For those of you who are new to this webinar series, welcome. Hopefully you'll find this useful. In this series we talk about the fundamentals that are affecting the markets right now, in particular FX markets. We follow that up with a look at the charts themselves, where we cover what hopefully is a wide range of currency pairs, which hopefully cover many of the markets which you'll all be looking at. In terms of the fundamentals this week, it has been quite a packed agenda, not just on the economic calendar itself, but also in the wider political spectrum. Where to begin? I guess it's always best to start with Donald Trump. He announced that some tariffs, trade tariffs, would be enacted by the US. He wasn't specific on who they would be enacted on. The inclination that we've had is that they will be wide-ranging on all trade partners. This is 25% tariff on steel, 10% tariff on aluminium imports. This is, in his view, a means to balance trade, a means to create fair practice on trade, and for trade to be equal with the US. He thinks that other countries are taking advantage of the US on their trade deals, which have been badly negotiated before, and this is a means for the US to level things up a little bit and make them fair and reciprocal, as he likes to say. The results of what he's done, it's been quite badly taken from a market perspective, as well as a broader political and wider perspective, both inside and outside the US. The reason being not that people necessarily disagree with what he's saying, that the US does not necessarily have the best trade deals. More so what this can cause taking this action, rather than renegotiating with countries as they are with NAFTA. Using such heavy-handed tactics does have the potential to trigger trade wars, and that is seen as beneficial to no one. Trade wars tend to lead to higher prices, tend to be felt by the end consumer, tend to weigh on the global economy. Everyone loses, and that's what people want to avoid. But of course, if one country is taking a unilateral approach to this and imposing tariffs, other countries, other regions are going to respond. We've heard from the EU that they will look now to impose counter tariffs against the US, looking at industries that heavily export to Europe. So they have touted industries like whiskey and Harley Davidson motorbikes, for example, as a way to hurt the US back. The US has already, or Donald Trump himself has already countered that by saying that he would target European cars, which import quite heavily into the US. Again, no one's saying necessarily that the US has the best of these trade deals. The cars one is a key indicator of this. It was highlighted by a few people now that the US's tariffs on European cars is 2.5%. It's worth noting, most countries do have tariffs already in place. It's about finding a balance that creates an even playing field, and that's the point of trade talks and these agreements, is to try and create as even a playing field as possible. The US currently imposes a 2.5% tariff on European cars. The European Union imposes a 10% tariff on US cars. So this is one of the areas where Trump is claiming that there is this unequal level playing field. And while his end goal really is not necessarily explicitly known, I think it's quite clear that what the tactics he's using at a time when he's trying to renegotiate trade deals like NAFTA, at a time when he's open to the possibility of rejoining the TPP deal, which he previously pulled out of, at a time when he will be looking to start negotiations with the UK post-Brexit. The threat of these heavy-handed tactics, which no country wants to be part of, is a means to an end, the end being a better trade deal for the US, something that he can sell politically, something that will satisfy and appease his core base, something that will cast doubt on those who have questioned whether he can achieve what he promised to in the election campaign. So for him, it's win-win, but people are very concerned because I think from an outside looking in perspective, while this may be a threat, it's very much a threat that the wider public believe that Trump would happily follow through on. He said himself that trade wars are easily won. This is the language of someone who is willing to accept economic pain for the purpose of doing what he believes is correct and for following through on a promise which he made during his election campaign. And that doesn't work to anyone's benefit economically. So that weighed on markets early on Friday. We have seen a rebound. And the reason why is that he did soften his rhetoric in some way when talking about NAFTA, saying that basically if they renegotiate NAFTA, which has been very, very slow to this point, and if they come to a deal that satisfies him, then maybe these tariffs won't be imposed on the likes of Mexico and Canada. There's also been strong opposition from members within his own party who have supported his other policies, largely speaking, including House Speaker Paul Ryan, who has made clear his opposition to such tariffs because of the economic impacts this can have. This has suggested to people or indicated to people that he may have difficulty getting certain things over the line. That's not to say he can't, that he couldn't push for them personally, but the lack of support from within his own party makes them less likely, particularly if the European Union does do countermeasures. This back and forth would be made more difficult. So that's had an impact on the markets late last week and early this week. We've also had the elections in Italy, and there we saw you could see here, took place on Sunday, and this went in a way as we expected, in that there is no majority government that's being elected at this moment in time. It went badly if you are a fan of Europe having closer ties. The two areas that did the best were the centre-right bloc, which as a unit was effectively won the election, but without a majority, and the biggest party in that bloc was the League, or the Northern League as it's referred to. These are highly Eurosceptic. They haven't promised a referendum on the EU membership, but they are highly Eurosceptic, and the largest party alone, single party, was the Five Star Movement, another very Eurosceptic party that wants change, a party that has previously promised a referendum on being in the EU and the Eurozone, that has not promised it as part of this election campaign, but I don't think it would take much for it to reignite, particularly if it went into a coalition involving the Northern League. At the moment, markets are quite okay. The FTSE MIB in Italy sold off yesterday in reaction to the event itself, this knee-jerk reaction. Yields did creep higher a little bit because of the undesirable outcome from a markets and a unity perspective. But still, there's a long way to go before we start talking about referendums, even in the worst case scenario of a coalition involving those two parties, which previously they've alluded to the fact that they would not be interested in joining. So we're still a long way to go on that. I think that's what explains why the euro has been relatively unresponsive, and why other European markets have also been relatively unresponsive. On a more positive note, in Germany, the SPD voted in favour of going into grand coalition with Angela Merkel's CDU-CSU alliance once again. So that should put to bed the uncertainty and the political concern that's hung over Germany for months, although there's been no economic impact, and will now begin in Italy. So that was a positive for Europe over the weekend. Now we move on to more of a markets perspective, and we have another big week ahead. We had the services and composite PMIs yesterday. Overnight, we had the RBA decision and rate statement. No change there. Not much to take away from that on this occasion. We've got some speeches today and over the next few days from different central bankers. But really, the next few days is where it gets quite interesting, because we have, you can see we've got things like the ADP employment change here on Wednesday, which means that come Friday, we've got the US jobs report, arguably the biggest economic event or report that we get each month. We've also got the Bank of Canada interest rate decision and rate statement. Now they have, I believe, slowed their rhetoric on rate hikes, but very much committed to tightening monetary policy. So that we've watched very closely and could trigger a lot of CAD volatility. We've also got things like the labour costs and non-farm productivity, which will be interesting as well. Come Thursday, we've got more economic data, but most importantly, we've got the ECB rate decision and press conference early afternoon in the UK. And again, people are looking for signs that the Eurozone is going to start to drop some of its more dovish language. What's expected tomorrow is that it'll drop its language referring to it will increase its asset purchases again if necessary. Now, this may seem small to you, and it is small, but the ECB focuses on its wording very, very carefully. It's very careful about how it sends out its messaging. It's very planned. It wants to ensure that we don't see excessive volatility in the markets, particularly volatility that results in the euro going aggressively higher in a short period of time, creating further policy issues for them further down the road. So while this may seem like a small change, should it occur, it is effectively a step towards ending its quantitative easing program. Now, that could come in September when the current one expires. It could go from 30 billion a month to zero. What the ECB may do to be extra cautious is to slowly taper that out over the next 3 months to zero. Really, it's irrelevant if I'm perfectly honest, or as far as I'm concerned. I think they should just cut it to zero from 30 in September and move on. But they're very cautious about how they do their exit. They really don't want to see a strong euro, and these are the measures which they're taking to do so. But the first sign should come on Wednesday, possibly with the removal of that language, which they have warned about at recent meetings. Then Friday, we've got the US jobs report, which of course is the biggie. We've also got the Canadian jobs report as well. We've got some UK data in the morning, some Chinese inflation data overnight, and also the Bank of Japan interest rate decision and press conference as well. Again, there has been speculation about the Bank of Japan beginning to exit its quantitative easing program in 2019. And that'll be very interesting to see from the monetary policy statement and press conference earlier in the early hours of Friday morning. So like I say, plenty of economic events still to come this week. A lot of focus on the central banks. There's a littering of central bank speakers occurring over those days as well. But also, we can't forget about the political backdrop, because between the Trump tariffs, the ongoing Italian situation, and any other unforeseen announcements, the markets are likely to remain quite volatile. For example, we've seen half an hour ago, well, maybe an hour ago, just over, there was an announcement from South Korea that they are, having spoken to North Korea are open to talks with the US to discuss denuclearization. This was seen as a very positive step. This removes, if a solution is found, this could remove one hurdle on the way to improved geopolitical environment. This is something that has weighed on the market at times over the past couple of years. These constant tests, this constant rhetoric between Kim Jong-un and Donald Trump. Progress here is positive for the markets, and that's why we've seen this strongly risk-on move over the past hour to an hour and a half. We have seen the euro and pound, for example, favoured over the dollar and the yen. And the dollar in itself was preferred to the yen, but as always, there's different variances of how what's perceived risk on, risk off. Yen's always seen as the yen and the Swiss franc are always seen as the biggest risk off currencies, or the safe havens. The fact that we've seen the dollar losing ground against the pound and the euro, among others, is why, despite this being a positive risk event, gold is still rallying on the back of that weaker dollar, and we've also seen a real rush higher in equity markets as well, and US futures also, US Treasury yields as well coming off a little bit. Again, just showing this move into this this risk-on trade that was playing out as a result of that announcement again. So we may see more of this over the next few days as well. So a lot of political stuff going on right now, but also a lot of economics this week as well. From our perspective, that's great. Volatility is good. We like volatility. We want volatility in the markets, as long as it's moderate and reasonable. Moving on to the charts now. We'll start with euro dollar. As you can see, the euro is up on near its daily highs, but after that move, we're back around the 124s. We're still stuck in this pattern at the top, what looks like a topping pattern at this moment in time. You can see that the last time we made a high here, it was done on less momentum, which was highlighted in the previous video. Since then, we did see a correction back. It looked as though we were going to break lower. We took out that previous low, but there was this support area here of just around 122, just above and below, and the 55-day simple moving average, and we did find support here, and we were seeing a bit of a correction. Now, if this was a double top that we were seeing playing out here, and this was a break of the neckline, the levels I'd be focused on right now would be the big fib levels. Right here. Now I'll change the color just to make it stand out a little bit more. So I'd be focused on the 50 and 61.8. In these circumstances, I'd even consider the 78.6. And a break at a double top and then a rotation off that fib could be a signal of a move lower, and then obviously confirmed by a break lower here. This move to the upside, this potential corrective move, has been exacerbated by this news that we've had out, which is why we've flown so comfortably through the 50 fib. But again, 124.70, 124, I think are notable levels here. A rotation lower of which could signal a correction in what has been a very strong rally in the euro dollar pair. Mainly it's been a decline of the dollar, but the euro moves higher have helped. Same applies to euro sterling. You can see that this actually played out quite nicely here, because we are having these nice moves higher in the pound dollar. We then had this kind of mini double top here, which corrected lower back towards these kinds of levels. We then saw a correction back, and again, we had the fib levels here. It came back to the 61.8, and then we rotated low. We've made the new low. So I'll just move this fib low here for in case this is another correction. And again, I'll be keeping a close eye on these fib levels. This has been aided higher again by the weaker dollar on the back of that North Korea news. But nothing's really changed here. We're back in this 55.89 area on the moving average band. We're also into the 50 fib level, so you're always going to find you're often going to find some support here. It also coincides with a prior level of resistance as well, so notable support. So there's plenty of potential support here, but a breakthrough here could be quite a bearish signal. Initially into the 61.8 fib, but potentially lower. But these are the levels which we'll be keeping a close eye on. Again, should we continue to see this rotation to the upside, I'll be looking around this 50 fib, around the kind of 140s, nice round number. We don't want to see a new higher high, because that could signal a continuation of move to the upside. And really, when you've seen such strong rallies, you'd like to see bigger corrections here. They create more even markets, I would say, and they make you more worried about sharper corrections later on down the road, I'd say. So a few levels to keep an eye on there in pound dollar. Euro sterling, where we've continued to see that little push higher. Again, we're really still sideways bound. We've broken through these recent highs, so in a short-term sense, we are outside the top end of the range. We've also held above this rising trend line, so I'll be keeping a close eye on that. Should we come back towards these kind of 88.40s, you've got the moving average collection potentially here, but you've got the rising trend line. There's not really too much to read into this, really. If we break above 90, or we break below this kind of this lower part, this range here, around 87, 88, then potentially that would be a nice signal. But for now, we're choppy, it's consolidating. It's two strong currencies battling out against each other. And so it makes it a difficult market when you're looking at trends to form an overly aggressive judgment on. In the near term, I'd probably be a little bit more bullish than bearish. We've had this nice little run up here. We've taken out new highs. We've had consolidation here. But really, into 90, recent experience would suggest to us that you're going to run into a lot of resistance. So that'll be a very interesting level. A break above here, and things start to get a lot more interesting once again. Aussie dollar, again, this looks a little cluttered on the chart, but let me break it all down and try and make it a little clearer. So we had this nice rally higher up towards these previous highs. We ran into resistance. We had a correction back to the downside. We came into this cluster of moving averages. Now, it looks messy when they're all combining together, but if anything, that's what I like to see. This is 4 notable moving averages, including the 200-day moving average, which everyone will have heard of, as well as the other moving averages, which I like to use on my charts, all clustering together, providing potential support for the pair, but more importantly, providing signals. A break below the moving averages would be a very strong bearish signal for me, especially with it breaking below the 61.8 fib, which would suggest that this recent move was not a correction of the broader move, which would suggest it was an actual reversal. Could potentially open up a move back towards these previous lows here. At the moment, we have found support. You saw 3 days where we tried to break below, nice long lower wicks, and now we are pushing higher on the back of that North Korean news. A nice little bullish burst here, or bearish for the US dollar. You can see here off these highs, we had the 61.8 fib as well. Nice move off the highs and a nice rotation lower off there. We also made a new low in that period. It's, again, this is not a market that's trending particularly nicely. So you're looking, when I'm adding things like fibs on here, I'm looking for interesting levels. I'm not looking for predetermined rotation points. I'm just looking for interesting levels to keep an eye on. So in that point on this one, it was a case of, is this a rotation higher, or are we still in this consolidation phase? And the bounce off the 61.8 fib to me suggested we were still in the consolidation phase. We made a new low. We've dropped it to the recent low of the recent high. I'm just leaving the orange fib on there because we still haven't closed below the 61.8 fib or those moving averages. If we do, then I'll remove that. And should we rotate higher, I'm looking at the previous highs around here, but really around this fib zone, I'll be paying very close attention. A break above the 61.8 fib, not previous high, would suggest we're heading back to these prior highs. But again, we are sideways trading here. We are range bound in Aussie dollar, and therefore the fibs only give us a slight indication as opposed to give us concrete information. Dollar CAD is looking a lot nicer. You can see we've been moving in nice trends. You can see these these levels which you've had around 124, 126.5, around 129 up here. We just respected these levels on numerous occasions. We had the support here, we broke below, we found support here, we broke below. When we broke higher, we found support here again. Resistance here from the previous low, support around the previous high. And we've run higher. Now, we've made a new high, which is really interesting. We've broken above the 200 and 233-day simple moving average band. This was support here, support, broke through in immediate resistance, resistance here on the way down, resistance here recently. Breakthrough here, I think, is a very bullish signal. The fact that that's been accompanied by a break for that previous high reaffirms that for me. I think that was initially holding prior to this North Korean news, which was weak for the dollar, which is why we've broken back below. As long as we hold above this moving average band, I'm still bullish. I'm still bullish here. This is very different to the Aussie dollar pair. I'm very interested in the move in the fib levels in this case, because I think this is looking very nicely bullish indeed. Let me just add this on here. Go back to my favoured orange. Now, in terms of where to draw your fib to your fib swing highs and lows, it's very much up to you. I'd like to see it come back towards these kind of fibs, a 50 and 61.8. I don't necessarily think that might happen. That'll happen on this occasion. So I'm going to use this most recent swing low, which is perfectly good. You got two higher lows to the left and two higher lows to the right. And on this occasion, the 50 and 61.8 comes into play around the moving average band and that previous high. So move back to here, and I'll be very interested to see how the markets react. I'd love to see a little rotation higher, and a break below would suggest that this isn't looking as bullish as it previously was. Whereas a nice rotation higher for me would confirm that bullish breakout and suggest we're heading back initially, hopefully towards those kind of 132.50s. But again, this is a daily chart thing to change on a day-to-day basis. But for a while now, this dollar CAD chart has been very nice from a technical standpoint. Sterling CAD, we had that break higher. We highlighted this in the previous video, the fact that we had this resistance, we had these rising lows, so we were saying that this is looking quite bullish in a bullish move. We broke above here, we consolidated while always finding support on that previous resistance, and now in the last few days we have had that move higher towards just around the 180s. Now you can see that we've got resistance on here. That comes around that prior support. We've run short a little bit, but really we're only seeing consolidation at the moment. So I wouldn't be surprised to see another run at that 180, 181 kind of level. This for me is consolidation in this very bullish move. And you'd see that if we drop, for example, down to the 4-hour chart, that this is just a consolidation at this moment in time. I'm not particularly concerned about this. I'm looking at this momentum indicator, for example, higher highs on the MACD moving averages, higher highs on the MACD histogram, higher highs on the stochastic. For me, this is still bullish. We're seeing a bit of a corrective move right now, or a bit of a consolidation move right now, but I still think this is bullish. I still think we can see another run at this 180, 181 zone, and a break above there, which may not come straight away, but if it does, then that could potentially open up a move to these kind of 185s prior support you can see back here, back in 2016. So nice little bullish moves here. Near-term consolidation, potential for a little bit more of upside in the near term. But if we see a corrective move, as I always say, there's nothing wrong with that whatsoever. And again, that's when we start keeping an eye on the fib levels, particularly those that coincide with prior levels of support and resistance. Here, the 50 and 61.8 fib coincide nicely with this prior resistance, so that'll be a notable level as far as I'm concerned should we get that correction. Kiwi dollar, US dollar, without meaning to sound like a broken record, we are seeing dollar weakness today. That's helping this pair to move higher. Again, we're in this position where we had this kind of double top forming here. We were testing that support. We had a bit of a correction. I added my fib because if we're going to see a breakout of this kind of double top, then the fib may represent an interesting rotation point lower and give us an indication of whether we're going to see a breakout or a move back towards these previous highs. Potentially then you're looking at triple tops or even continuation of the bullish move. This dollar sell-off has seen us power through the 38.2 fib, so that brings the kind of 50 and 61.8 fibs into consideration as well. I'm not particularly interested in this level, even though we are holding around here at this moment in time. But a break through the neckline here would also take us through potentially these 200 and 203 at 33-day simple moving average band, which for me is a bearish signal. Nice big double top as well could give us a possible price projection much lower. Should we see it? I'm not going to get ahead of myself, but as you know from the textbooks, these double tops, the price projections that it gives, it indicates, or it suggests, the textbooks would suggest that you take the move from the neckline to the top, and you take the size of that move and you project it below the neckline, and that gives you your possible price projection. In this case, that would be 71.75 through 74, roughly 74.50. So that's around a 275 pip move, so that takes down to around these kind of 69 levels, 69 coming around that lows really, this prior support here, the prior support levels, but really that you back in the support zone here. So something to be aware of, but again, I'm going a little bit ahead of myself here. But again, another chart that's for me is looking very interesting right now. We'll wrap things up with the yen pairs. Dollar yen, we're already back at multi-month lows. end of 2016 levels. We found support around that previous resistance and support zone. Initially, we did rotate back to the 50 fib, fell just short, but back into that support zone. Lovely rotation lower, a new low made. Interestingly, there was no momentum with the sell-off though. Higher lows here on the stochastic, higher lows on the MACD moving averages, higher lows on the MACD move histogram. We've made a new low, but already we're rotating higher. There's no reason why we couldn't make another new low again, but it would suggest to me that the momentum is just not with the move. That said, should we see a nice correction into these 50 zones again, back in towards the cloud, maybe the selling pressure will pick up once again. Who knows? We'll be keeping a very close eye on these fib levels, on those previous support zones, and seeing if bearish momentum does pick up there once again. But in the near term, I'm not particularly bearish because the momentum doesn't seem to be with the move, and it's really struggled despite breaking that low, which is never a good sign. Sterling yen, on the other hand, is probably looking more bearish than dollar yen. Again, without meaning to sound like a broken record, this risk-on move has benefited this pair. So earlier on in the day, this wasn't looking quite so bullish. We'd broken through the 200 and 233-day simple moving average band, which is a nice bearish sign. We've broken through previous support as well, a nice bearish sign. We were testing from below. We were holding below. We still haven't closed above this previous support. We still haven't closed above the moving averages, so this is still bearish. If we fail to close above here, it'd be lovely to see a nice rotation down, and that would confirm the bearish bias. We'll see how that closes the day. A close above, and I'm not particularly bullish though. There's no reason why we couldn't see a correction and still a rotation lower. We're still below the cloud. We've already broken below the 55.89 moving average band, which was providing support along with the cloud all the way up. For me, this is still bearish. A rotation off that 202 to 33-day moving average band makes it increasingly bearish for me and gives us additional confirmation, which is always what you're seeking during upward or downward trending markets. Euro yen's very much in the same boat. We've made new lower lows. We're testing the moving average band. We've tested it a few times. We've really struggling to break below. We've rotated higher. The risk on trade today is aiding this move. We're still finding resistance around that prior area support. I'd love to see a rotation lower off that, but if we don't, again, it doesn't mean I'm going to be bullish. I'm going to be looking at this kind of 60-61.8 fib zone. This keeps us below the cloud. It keeps us below the moving average band, and it still would suggest that this is corrective rather than a change of trend. A rotation low of here would also be very good. But in the early part of this trend, having just broken through the cloud, having just broken through the moving averages, a rotation lower off here would be very, very interesting, and especially if it's accompanied by a whole break and hold below that 202 33-day simple moving average band. And again, if we see it on pound yen, then given the correlation that we're seeing of the strength, weakness with euro and pound right now, then that could be a leading indicator for the euro yen pair as well, potentially. Okay, that's all for today. Thank you very much all for joining us. Thanks for all your input. And as ever, I wish you all the best of luck with the week ahead with your trading. If you've got any questions, feel free to reach out. You can find me on Twitter. My username is Craig_Forex. Apart from that, join us again, I think, in a couple of weeks for another webinar. But all the best with your trading. I hope you have a fantastic week, and I'll speak to you all again very soon.